Welcome to Dollars and Cents. Our podcast is designed to provide listeners with financial advice in a language you can understand. Created and hosted by Marc Freedman, President and CEO at Freedman Financial, he discusses timely topics that help individuals and families make smart financial decisions. Count on lots of energy, candid discussion, and a few laughs. And now, here's your host of Dollars and Cents, Marc Freedman of Freedman Financial.
Welcome back to another edition of Dollars and Cents with Freedman Financial. My name is Marc Freedman.
And I'm Marion Gilman.
And we're here to provide you with some financial advice in a language you can understand. It's been an interesting couple weeks. We're in the middle of April right now, and taxes are hopefully in, right?
Hopefully, absolutely. Wednesday was the deadline in Massachusetts.
Right.
Everyone else, it was Monday. Or not everyone else. I guess there are a few other communities and a few other states that have extensions as well. We were fortunate. We got an extra 3 days.
We do. We had a big week
2
here.
days.
Big week.
We
It's
did.
school vacation week this week. Boston Marathon was on Monday.
Very exciting.
Red Sox, as usual, lost at Fenway just before the game.
And it was actually a really nice day.
Oh, it was beautiful here. Absolutely beautiful.
Finally, some spring weather.
You know, but interestingly, with taxes being prepared over the past few weeks, and finally we're over the hump with that, perhaps you've filled out an extension if you haven't filed your taxes. But we got a lot of calls with a very similar question this year when it came to taxes this year, didn't we, Marion?
Why did I owe so much?
Yeah, why did I owe so much money?
Yeah.
And what are some of the reasons why people owed money? Was it, first of all, was it the accountant's fault?
It was not the accountant's fault. And it's typically not the accountant's fault. I don't want to say never, but it's rarely the accountant's fault. One of the things that I believe was miscalculated by many and not understood by many is everybody last year was so excited because we finally had interest rates that were above zero. So wasn't that fabulous?
Mm-hmm.
We could go to the bank. You could put your money in a high-yield savings account. Online banks were offering high-yield savings account. We have money market funds that offer high interest rates. And CDs, I mean, you were getting 5% on your money.
So think
fabulous.
So think about this. If you had money around, and let's say you had $100,000 around and you were able to buy a 5% CD or a 5% money market, and that was certainly something that you could do this past year.
Yes.
Well, 5% on $100,000 is $5,000, right?
That's right.
So you think, oh, great, I just made $5,000. Well, guess what? Unless that money was in an IRA, that $5,000, whether you took the money or reinvested it, was taxable to you.
That's right.
And how much tax did you have withheld on that reinvested CD money?
Well, they typically don't withhold at the bank, nor do we withhold on a non-retirement account. So there was no withholding. So even if you had never paid taxes before, all of a sudden you add $5,000 to your income, and that creates a tax bill.
Yeah, and if you're in the 20% tax bracket, that's $1,000 that's due in federal tax.
In federal.
And
state
and
of
there could be a state
Massachusetts, if
tax
you
as
live in
well.
Massachusetts.
So, you know, those incremental amounts, whether it's thousands or hundreds, I always find it interesting when people call the office and say, I owe so much in taxes. And they find out that instead of getting a refund this year, they owe $400. To me, that isn't a lot in taxes. It's just a check and balance system.
That's right.
But there were others that were very surprised.
Right, and the other part of it is, once again, along with higher interest rates, we had higher dividend rates on bonds. So as you know, many of you, if you invest with us, we have bond funds in the portfolio, and they paid out higher dividends last year. As well, there were capital gains. We had a great stock market.
Market did well.
And you know, along with those gains comes taxes. So we could lose your money too.
I love telling people this when they say, Mark, I had to pay so much in taxes because of my investment portfolio. And if you'd like, we could try really hard to lose money for you so you won't have to pay taxes. But I'm sure that's not what anybody wants.
That's not the goal. And the other thing is, I really want to caution everybody about comparing yourself to somebody else. So no matter who it is, first of all, you have no idea what their financial situation might be. And even if, let's say, you know, you're single and a friend of yours is a married couple, and you both have similar finances. You've discussed this, you know this, and all of a sudden this year you both went and got 5% CDs, and you owed taxes, but they didn't. Well, don't forget that each individual gets a tax deduction on a tax return. So if it's a married couple, you get 2 standard deductions if you're taking a standard deduction, which is a significant amount of money. I think it's up to like $14,000 per person now, something like that. But that's a lot. So if you're single and you're only getting one of those and a couple is getting 2, that's not your situation. It's a totally different situation.
But there's even more than that. I mean, think about each of us. If you're working, you get a paycheck and you have taxes withheld. People have different amounts withheld from their taxes, and it's all based upon not necessarily what they make, but what you choose on your W-2 form as to what you'd like to have withheld. Perhaps also you're taking a distribution from a retirement plan. Maybe you have a certain amount of taxes withheld there, while other people don't. And one thing that we noticed this year, a lot of clients this year applied for Social Security for the very first time this year. Well, generally, when you apply for Social Security doesn't withhold taxes. And many people think, oh, well, maybe my Social Security won't be taxable. That's not true.
No.
Upwards of, at the most, 85% of your Social Security can be taxable.
So that means that only 15% of what you receive is not taxable if you're in that highest bracket.
And when I raised that point to many people, when they were surprised to see how much they owed in taxes, they said, well, why didn't I have taxes withheld from my Social Security? Well, that's an adult problem. That's an issue that's on you. When you apply to the Social Security Administration, chances are they ask, but even if they don't, on the form that you can fill out, there is a form from the IRS that indicates how much tax would you like to have withheld from your Social Security. And it's one way, frankly, to check that off rather than having your accountant tell you, oh, you need to start paying estimated taxes. Because most people don't want to do that.
Because you forget. Estimated taxes are not due on a typical quarterly schedule. They have an unusual schedule in that they're due April 15th, June 15th, September 15th, and January 15th. That's not a traditional quarterly schedule.
No, it's not.
So you need to keep track of that. So April and then June, 2 months later, you've got to send in those payments. So you're much better off having taxes withheld, and it is a separate form that you need to send in to Social Security.
So one of the things that we
Be sure you do it.
Yeah, one of the things that we enjoy doing for our clients is we ask you for a copy of your tax return at the end of the year.
Right.
We run it through our tax analyzer to try to understand what were the taxes that were due and where were those taxes where was withholdings done or payments made to fulfill that tax payment.
Right.
And oftentimes we can help you readjust those tax withholdings by taking a little bit more from maybe your IRA distribution, giving you guidance on what you need to have withheld from your pay stub, letting you know how much to have withheld from a pension check or a Social Security check or whatever else it might be. Those are very critical parts of the financial planning side that many people in our industry don't really talk about. They're just interested in trying to help you get a better return or pick this investment or buy that investment. It's one slice. Picking investments is just one slice in the overall pie of financial planning. And I think taxes play an enormous component.
Absolutely. So don't forget to have withholdings done. It's the easiest way to pay your taxes. And the other part, the other thing we want to remind you of is just because you owe taxes in April or whenever you file your tax return doesn't mean that you're paying more tax now than you did in previous years. It could be just that you withheld less this year than what you owed or what you owed in the past. So you need to be careful of that. Owing something doesn't mean you're paying more.
Yeah, it's critically important to make sure that you are diligent and responsible for understanding the taxes that are withheld from your sources of income so that you're not surprised when you go to visit the accountant. But one of the other things that's surprising people this past few weeks is the fact that, you know what? The stock market doesn't go up all the time, does it, Marion?
Are you sure?
I
thought for sure it only went
Yeah, I've been doing this for 33 years, and I know that there are times when things are great and times when things are really lousy. And I'm not saying the times right now are lousy. No, times aren't lousy. Times right now are normal.
We're still up from beginning year to date. We are still, the stock market is still positive. All three indexes, the S&P 500, the Nasdaq Composite, and the Dow Jones Industrial Composite, are all up still for the year. Just not as significantly as they were a month ago. Let's put it that
Right,
way.
but we need to put things into perspective, and
Right.
we had done a webinar last week, and we do quarterly webinars for our clients and anybody, frankly, that joins our newsletter. If you get our weekly newsletter, you'll learn about our webinars that we do quarterly. We bring people up to date on what's going on in the world. We make some economic perspectives, offer some economic perspectives, and also offer some financial planning thoughts as well. But many people thought we were going to talk about what we need to do because the stock market is down. And frankly, it's nothing, the fact that the stock market is having a couple rough weeks isn't something that's of concern to us. And in fact, we got a report from a friend of ours. His name is Ryan Dietrich. He is, I believe, the chief economic strategist or chief investment strategist over at the Carson Group. Ryan used to work at LPL Financial, and he puts together, he's really a great statistician, and he tries to put things into perspective. And so he posted something on Twitter last week which had a reference to, trying to see where this, it comes from the Carson Institute research. But I wanted to share this story. Maybe you can actually just read it off, Marion, and let people know what Ryan had to say about how we think about markets.
So when we think about a market over the course of any 1 year, markets always go up and they go down. That's just part of the game. I mean, again, we always tell people you have to take a little risk if you want to make money long term. And meaning the risk is sometimes the market's up, sometimes it's down. And we have some time frames when, essentially it just seems like it's always going up, and other time frames when it's always going down. But when you look at history, if you look at any 1 year, an average year, the stock market goes down 3%, which is not an insignificant amount. It goes down 3% more than 7 times over the course of 1 year.
That's in 1 year.
1 year.
Seven times.
We only have 12 months. So that means 5 months may not have a dip, say.
Right.
If it was once a month.
But
right?
if you looked at how many times the markets move 1% a day, either up or down, I don't know what the statistic is, but I'm going to take a guess here and suggest that maybe it's 40 to 50% of the time.
I wouldn't doubt it in today's market.
Right.
It's very true.
It used to not be like that, but the
No.
market is far more volatile today
Right.
on these 1% moves. But there are days, like you said, there are more than 7 over the course of the year. The market will drop 3% 7 times on average over the course of the year.
And that doesn't mean it does it in 1 day, but over the course maybe of a week, however long it is, it does go down about 3%.
Right, and we felt a couple of these
Over
already.
the past couple of weeks.
But how about 5%, Marion?
Yeah, and it goes down about 5%, 3%, 3 separate times over the course of the year.
Right.
So 7%. I'm sorry, 7 times, 3%, 3 times it goes down 5%.
And this is coming from Ned David research, dated the 3rd of January.
Yep.
Also comes from Carson Institute as well. And then it's not uncommon to see a 10% correction
Every year.
once per year. 10% correction.
And that doesn't mean the year's going to end up down. It just means at some point over the course of the year, the market will likely go down from peak to trough about 10%.
And let's remember that 10% or more means that the market has gone through a correction. When the market goes down 2% or 3% or 5%, it's just gone down. It hasn't plummeted, though that's how the news might share that. It's gone down a little bit. When it's 10% or more, it's a correction.
Right.
When it's 20% or more, it's what's called a bear market.
And that never happens.
Well,
right?
it happens about every 3.5 years you go through a bear market. Now, bear market means more than 20%. Does it stay down for 20% forever? It
No.
could, but think about what happened during COVID, right? The market
Absolutely.
dropped, I think it was 35 some odd percent.
Oh, yeah,
At least that,
yeah,
35%
right.
in a very short period of time. That was a bear
I think
market.
it was like 3 weeks.
But it recovered very quickly.
Very
Same thing happened during the financial crisis. We've seen lots of these periods of time when there are large drops, but they respawn back. Will they always respond back? Well, history suggests it will, and history is no indicator of future performance.
No.
But we seem to believe that when you're well invested, you have to expect downs as well as ups.
And we've been through this. So Marc has been doing this for 33 years. I've been here for 24 years. And every time we've seen one of these 20% corrections, 20% bear markets, we have always recovered.
Absolutely.
There has not been a time when it hasn't recovered and gone on to greater heights.
So let's kind of recap again. We know that the market's off a little bit right now. We said that there are going to be, expect 7 times over the course of the year for the market to potentially drop for a period of about 3%. Expect it to happen.
Right.
Now, that's not in one day, but it could happen over a week or two.
And
We're kind of sitting in that
happen several times.
several times. Expect it to happen 3 times for the market to drop about 5% in a given year. Expect a 10% correction to happen once every year. And expect a bear market to happen at least every 3.5 years. So when we put all of that into perspective and we think about, well, the market's been off for a few weeks. Yeah, it has. We're not seeing those all-time highs.
So what's gone on in 2024?
So the largest...
We've had a bear market, right?
No, we have not had a bear market.
Sure?
We have not had a bear market.
Okay.
We haven't even had a correction. In fact, through April, right? April 15th, from January to April, the largest pullback we've had so far, peak to trough, is 2%.
So we're not even at that 3% that happens 7 times a year.
Right. So think about this. This would be the smallest movement for a year since it was 2.5% movement in 1995.
So 29 years ago.
So to think that we wouldn't go through a full year without some scary moments just isn't realistic.
No.
We're going to have them. We've had periods of time when the market just goes down or the market goes up. But going through this waviness, that's what's going to happen. That's why we say to our clients, that's why we say to you who are watching this podcast, when you're investing, look to the horizon. Keep your eyes off the waves. Look to the horizon, especially if you are investing long-term. And when you work with us, we're only investing long-term. We're not looking for speculation. We're not looking for a quick hit. Volatility, remember, is the toll we pay to invest. That is the cost of investing. It's called volatility.
Because you know what? Volatility happens on the upside too. And that's what we all want. We only call it volatility when it's on the downside though.
Right.
Have you noticed that?
That's right. People call it volatility then.
Oh, the market's so volatile. Well, you know what? When the market was going up and some of these meme stocks or NVIDIA was up 200%, people weren't calling that volatility.
No, no one calls us to say, hey, thanks for a great month.
Not that we invest
No,
in individual
no,
stocks.
we don't.
We certainly do not.
But when you look at your one-year performance, those numbers have looked relatively good. I mean, they've looked very good compared to a previous year or whatever. We just have to keep everything into perspective. We're investing for the long term, and your investments all weave into everything else in your financial life. And that's what's most important, understanding where everything is and what everything is worth.
And how you can use what you have to reach your financial goals.
And that's going to do it for us this week with Dollars and Cents. If you'd like to get our newsletter, if you'd like to receive this weekly podcast through our newsletter that's available right in the newsletter actually, or of course you can follow this podcast. You can pick it up on any of the streaming services. Just search for Dollars and Cents, search for Freedman Financial. You'll find us. If you want to get our newsletter, all you need to do is go to our website, freedmanfinancial.com. That's Freedman.
2 E's and a D.
Financial.com. Go to the bottom of any page, put in your name and your email address, and you will get registered for our email and our newsletter. That'll do it for this week. We'll be back again next week with more Dollars and Cents. Nice to see everybody. Have a great day.
Have a great week.
During today's Dollars and Cents episode with Freedman Financial, your hosts may have discussed specific financial planning and investment ideas that are for general information only and not intended to provide specific advice or recommendations. Please remember that investing involves risk and may include loss of principal. Although the money market fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in the fund. Always consult a certified financial planner professional, qualified attorney, or tax advisor prior to investing to determine what is appropriate for you. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC.